The Excel includes 4 parts: basic information, future value, growth rate, and WACC. We chose the financial industry, and China Securities Corporation Limited was targeted. Here is the basic information. In terms of Grade A office, we chose the Bank of American Tower, and the reasons are discussed in detail in the report. The data needed are listed here. For the office, we need to know the rent, price, and growth rate of the price, especially for the middle level, because it is the middle level that provides an office size around 10,000 square feet. Then, according to the sale price, we calculated the compound annual growth rate and then used it to calculate the resale price here. For the company and the market, we can get this data from this source, and then we get our expected return here. Anyway, we focus on our future value. There are 2 plans: Plan A for renting an office and Plan B for buying an office. We will choose the plan which can generate more future value. The first thing we need to emphasize is that we assume the total investment in both cases is the same, like here and here, and the number is based on the transaction cost and the office price when buying an office. On the other hand, when we pay for the rent and the transaction costs at the beginning of the first year, there must be some spare money compared to this number. So we use the money to invest other business, and this is the basic point to compare these 2 plans. The second thing is that we assume the revenue is generated at the end of the first year. It is also the beginning of the next year when we have to pay rent. So the other investment in the next year will be the revenue from the last year minus the rent, and then repeat in this way. So the revenue will be determined by the other investment in the beginning of the 7th year. Then we can get the future value 1. For buying an office, we just focus the resale price and the transaction cost. We assume there are no other income or expenses during these years because there should be the same when we're renting an office, so it won't have some bad influence on the final decision. So in this case, it is better to rent an office than buy an office because the future value 1 is larger than the future value 2. Then we do the Monte Carlo simulation. The first step is to add output. We define the future value 1 and the future value 2 as our output. Then we need to define our inputs. We chose the rent, purchase price, and the resale price. Then define their distributions. We choose the triangle one, and the numbers input in these boxes are shown in this chart. Then, when we input the iterations and simulation, click star, we can get these results, like the future value distribution in these 2 graphs, and we can find that the future value 1 is negative related to the rent, and the future value 2 is also negative related to the purchase price, but positive related to the resale price. It is clearly due to the formula itself, like this is -1, this is also negative, but this is positive. So it is reasonable to find these results. After that, we focus on the sensitive analysis. When the percentage change in the inputs become larger, like from 10% to 30%, the change in the future value 1 is also become larger. So it is reasonable to say that the future value 1 is too sensitive to the rent. This is also the case in buying side. But if the percentage change is not so big, like 10%, we could find that the future value 2 is more sensitive to the resale price rather than the purchase price. But when the percentage change become larger, like 30%, then they nearly have the same influence on the future value too. And this is our analysis. Thanks for listening and watching. Thank you. Bye.